Are you planning to buy a home and wondering whether a fixed-rate mortgage is the right choice? A fixed-rate mortgage is one of the most popular home financing options because it offers predictable monthly payments and protection from rising interest rates. In today's video, we'll explain exactly how fixed-rate mortgages work, their advantages and disadvantages, how to qualify, and whether they're the best option for your financial future. Let's get started. A fixed-rate mortgage is a home loan where the interest rate remains unchanged for the entire loan term. That means your principal and interest payment stays the same month after month, year after year. Unlike adjustable-rate mortgages, often called ARMs fixed-rate mortgages, don't fluctuate with market conditions. This provides stability and makes budgeting easier for homeowners. Common mortgage terms include 15 years, 20 years, and 30 years. The longer the loan term, the lower the monthly payment. However, longer terms generally result in paying more interest over the life of the loan. One major reason borrowers choose fixed-rate mortgages is predictability. You always know what your monthly principal and interest payment will be, regardless of future interest rate changes. Consistent monthly payments, easier budgeting, protection against rising interest rates, long-term financial stability, simple loan structure. If interest rates rise significantly in the future, your mortgage payment remains unchanged because your rate is locked in. For families planning to stay in their homes for many years, this peace of mind can be extremely valuable. Let's compare the most common fixed-rate mortgage options. 15-year fixed mortgage often has a lower interest rate and faster loan payoff. However, it comes with higher monthly payments. 30-year fixed mortgage offers lower monthly payments and greater monthly cash flow, but it results in higher total interest costs and slower equity accumulation. Many homeowners choose the 30-year option because it balances affordability with long-term ownership goals. Mortgage interest rates are influenced by economic growth, inflation, employment trends, central bank policies, and bond market activity. Lenders also examine your credit score, debt-to-income ratio, income stability, and down payment amount. Generally, borrowers with stronger credit profiles receive more favorable mortgage rates. To qualify for a fixed-rate mortgage, lenders typically evaluate your credit score, debt-to-income ratio, down payment, and employment history. Many conventional loans require a score around 620 or higher, and better scores often mean lower interest rates. Most lenders prefer borrowers whose monthly debt obligations remain below approximately 43% of gross income. Buyers may qualify with down payments as low as 3% to 5% depending on loan type, though larger down payments can improve terms. Stable income and consistent employment strengthen mortgage applications. Every mortgage payment contains two parts: interest and principal. During the early years of a mortgage, a larger portion of each payment goes toward interest. As time passes, more of your payment is applied to the principal balance, helping you build equity in your home. This gradual repayment process is known as amortization. Understanding amortization helps homeowners see how their mortgage balance decreases over time. What happens if interest rates drop after you obtain your mortgage? That's where refinancing may help. Refinancing replaces your existing mortgage with a new loan. Common reasons to refinance include lowering interest rates, reducing monthly payments, shortening the loan term, and accessing home equity. Keep in mind that refinancing often involves closing costs and fees, so it's important to evaluate whether the long-term savings justify the expense. Let's quickly compare the two major mortgage types. Fixed-rate mortgage offers stable payments and predictable budgeting, protection from rate increases, ideal for long-term homeowners. Adjustable-rate mortgage, ARM, lower initial interest rate, potential short-term savings, future payment uncertainty, risk of rising rates. If you plan to stay in your home for many years and value payment stability, a fixed-rate mortgage is often the preferred choice. Fixed-rate mortgages continue to be one of the most reliable and popular ways to finance a home. They offer predictable payments, long-term stability, protection from future rate increases, and peace of mind for homeowners. Before choosing a mortgage, compare loan terms, evaluate your financial goals, and speak with qualified lending professionals to determine the option that best fits your needs. If you found this video helpful, like, subscribe, and turn on notifications for more homeownership, finance, business, and educational content. Visit HUMANITYUAPD.com for more informative articles and guides. Thanks for watching, and we'll see you in the next video.